You can invest for 20 years. Pick the right assets. And still end up stuck. Not because you failed, but because you started in the wrong place. And once you see where most people go wrong, you'll never unsee it. Here's the uncomfortable truth most people never want to hear. You're not losing at money because you picked the wrong stock. You're losing because you started the game at the wrong place. Right now, millions of people are pouring money into the market, buying ETFs, chasing crypto, investing for the long term, while a credit card quietly charges them 22% interest every single month. No drama, no headlines, just steady, guaranteed damage, and then they wonder why their net worth never seems to move. That's like trying to fill a bucket with holes punched through the bottom and blaming the water for leaking out. What makes this even crazier is that on the surface, it looks responsible. You're investing, you're thinking about the future, you're doing the right thing, but underneath, the math is laughing at you, and your future self is the one who's going to pay for it. Here's a number that should stop you cold. 1 in 3 Americans has no emergency fund at all. The median amount saved for emergencies is about $500. $500. That's not even enough to absorb a minor inconvenience, let alone a real setback. Yet those same people are asking whether they should buy individual stocks or diversify into the next hot asset. That's not ambition, that's denial. Because before investing can help you, it has to stop hurting you. And most people never slow down long enough to realize they're building on a cracked foundation. They jump straight to the exciting part because no one wants to hear about boring steps. Safety nets, or order. They want upside. They want acceleration. They want results now. But wealth doesn't work that way. Wealth is built by doing the unsexy things first, in the correct sequence, even when no one is watching and nothing feels exciting yet. And the people who ignore that sequence don't fail loudly. They fail quietly, year after year, wondering why they're always behind despite doing everything right. Welcome to Quietly Broke. If any of this already feels a little too close to home, you're exactly where you're supposed to be. In this video, I'm going to walk you through the order almost no one follows. The order that quietly separates people who struggle forever from people who eventually gain real control over their money. Not hype, not shortcuts, just the truth most people skip. Before we go further, take a second to subscribe to the channel. It helps support the work here and gives us the motivation to keep making videos that actually challenge how people think about money. Now, a quick question for you. Be honest. Which one do you think matters more right now? A. Finding better investments. B. Fixing the order you're using your money. Comment A or B below. If part 1 was about realizing that you've been playing the game from the wrong starting line, this is the moment where you stop running forward and finally look down at the ground you're standing on. Because before money can help you grow, it has to stop putting you in danger. This is where most people get uncomfortable. Because the steps that actually protect your future don't feel like progress at all. They don't give you bragging rights. They don't give you screenshots. What they give you is stability. And stability is invisible until the moment you don't have it. An emergency fund is the first piece of that stability. And its real purpose has almost nothing to do with emergencies. It exists to protect you from yourself. From panic. From desperation. From the kind of short-term thinking that ruins long-term plans. When life throws something unexpected at you, and it always does, money becomes emotional. Fear speeds up your thinking. Stress narrows your options. Without cash on hand, you're forced into bad choices, selling investments at the worst possible time, taking on high-interest debt, or convincing yourself that this one swipe isn't a big deal. An emergency fund breaks that chain reaction. It buys you time, and time is what allows you to make rational decisions instead of reactive ones. That's why the goal shouldn't feel abstract or overwhelming. You don't start by aiming for perfection. You start by creating breathing room. Your first $1,000 isn't about being fully prepared. It's about proving to yourself that a problem doesn't automatically turn into a crisis. From there, 1 month of expenses changes how you sleep. 3 months changes how you negotiate. 6 months changes how you see risk entirely. The money matters, but the psychological shift matters more. And once that foundation exists, there's a second threat that has to be dealt with before investing makes any real sense: high-interest debt. Not all debt is equal. But debt that charges you double-digit interest is actively working against you. It compounds faster than almost any realistic investment return. And it does so with zero volatility. It doesn't have bad years. It doesn't take breaks. It just grows. Paying off that kind of debt isn't a setback. It's a guaranteed win. Every dollar you use to eliminate high-interest balances is earning a return equal to that interest rate. Without risk, without taxes, without hoping the market cooperates. It's the rare situation where the math is brutally simple. The strategy doesn't need to be complicated. Keep everything current, then focus every extra dollar on the balance with the highest interest rate. That's it. You're not being conservative. You're being efficient. You're stopping the leak before trying to fill the tank. This phase doesn't feel exciting because it isn't designed to be. It's designed to remove fragility from your life. And once fragility is gone, everything else you do with money becomes easier, calmer, and more effective. Once you've created stability and stopped the financial bleeding, there's a moment where the rules briefly change, and missing it can quietly cost you more than almost any bad investment ever could. This is the one exception where investing before you've fully finished cleaning up high-interest debt actually makes sense. If your employer offers a matching contribution to your retirement plan, that match deserves immediate attention. Not because it's exciting, and not because it feels sophisticated, but because it's the closest thing to free money most people will ever see. An employer match isn't a nice bonus. It's an instant return on your contribution. In many cases, it's a guaranteed 50%. Sometimes even 100%. The moment you put your money in. No market risk, no waiting, no hoping the timing works out. Think about how rare that is. People obsess over finding investments that might earn 10% a year if everything goes right. Meanwhile, they ignore a benefit that literally doubles part of their money on day one. That's not being cautious. That's being unaware. Here's the key, though. This isn't permission to go all in. The strategy is precise. You contribute just enough to capture the full match. And not a dollar more. Once you've secured that match, every extra dollar goes right back to eliminating high-interest debt. This way, you're stacking guaranteed wins without letting interest continue to drag you backward. There's also a detail most people overlook: vesting schedules. Some employers require you to stay with the company for a certain period before the matched money is fully yours. That doesn't mean you should skip the match. But it does mean you should understand the rules. Even with vesting, the math usually still favors taking it. This step is subtle, but it's revealing. People who understand how employer matching works aren't smarter than everyone else. They're just paying attention to incentives. They recognize that building wealth isn't about effort alone. It's about positioning yourself where the system is already working in your favor. Secure the match. Lock in the guaranteed return. Then move on. Because once this box is checked, you're ready to enter the phase where money doesn't just feel safer, it starts to move faster. Once you've secured the match and stop leaving guaranteed money on the table, something important shifts. You're no longer just cleaning up mistakes. You're positioning your money to grow with intention. This is the point where most people lose the plot. They feel momentum, they feel disciplined, and then they rush straight back into autopilot. Dumping more money into whatever account is easiest instead of asking a far more powerful question. Where does each dollar actually work the hardest? This is where tax optimization enters the picture. And it's where long-term wealth quietly separates from short-term effort. After the employer match, the next priority for most people should be an individual retirement account. Not because an IRA is flashy, but because it gives you something incredibly valuable: control. With an IRA, you choose what you invest in. You're not limited to a narrow menu of expensive funds selected by a committee whose incentives have nothing to do with your outcome. You can use low-cost index funds and ETFs that charge almost nothing to hold your money. Fees don't feel painful in the moment, but over decades they act like a slow leak. A 1% difference may not sound dramatic, but compounded over 30 years it can quietly cost you tens of thousands of dollars. That's money you worked for, handed over without noticing. Maxing out your IRA before adding more to your 401k is a way of keeping more of your own effort. Then comes a decision that confuses almost everyone: traditional or Roth. At its core, this isn't complicated. You're deciding when to pay taxes. Traditional accounts give you relief now and tax you later. Roth accounts make you pay today so you can withdraw tax-free in the future. The difficulty is that no one knows exactly what their income or tax rates will look like decades from now. A simple guideline helps. If you're early in your career and earning less than you expect later, paying taxes now through a Roth often makes sense. If you're in peak earning years and facing high marginal rates, traditional accounts can reduce pressure today. And if you're unsure, splitting contributions creates flexibility. Flexibility is what allows you to adapt when reality doesn't follow your assumptions. And then there's the account almost no one talks about seriously, even though it may be the most powerful one available: the health savings account. An HSA is misunderstood because people think of it as a spending account. In reality, it's an investment account disguised as healthcare. It's the only place where you can potentially avoid taxes on the way in, during growth, and on the way out. You get a tax deduction when you contribute. Your money grows tax-free while invested. And withdrawals for qualified medical expenses are completely tax-free. Even in retirement, no other account combines all three benefits. The real power shows up when you stop treating it like a checking account. If you can afford to pay current medical expenses out of pocket, you let the HSA stay invested. You keep the receipts. There's no expiration date on reimbursement. You can pay today and reimburse yourself years later, after compounding has done its work. After age 65, the flexibility increases even more. Non-medical withdrawals are taxed like a traditional retirement account. But medical expenses in retirement are not a hypothetical risk, they're a certainty. Healthcare is one of the largest expenses retirees face. And an HSA is one of the only tools designed to meet that reality head-on. Used properly over decades, an HSA can grow into a six-figure pool of tax-free money earmarked for one of retirement's biggest threats. That's not an optimization trick. That's strategic defense. This phase isn't about chasing returns. It's about making sure that when your money grows, it keeps as much of that growth as possible. And once you understand that, you stop asking how to invest and start asking where your money is allowed to compound without friction. Once you've done all of that, once your money is protected, optimized, and compounding with as little friction as possible, you finally reach the stage most people try to start with. This is where you finish maxing out your 401k beyond the employer match. At this point, the account stops being just a workplace benefit and becomes a serious engine for long-term wealth. You're sheltering a large portion of your income from current taxes, letting decades of growth stack on top of each other without the IRS taking a cut every single year. It's not exciting in the moment, but this is where scale starts to matter. Small decisions made consistently inside tax-advantaged space turn into large outcomes later. And only after that does it make sense to talk about taxable investment accounts. This is the part everyone wants to jump to. Because taxable accounts feel like freedom. No contribution limits. No age restrictions. You can buy whatever you want, whenever you want. Stocks, ETFs, individual ideas, long-term holdings. And that flexibility is real. Taxable accounts are useful for goals like early retirement, a future home purchase, or bridging the gap before you can access retirement funds. But that freedom comes at a cost. And pretending otherwise is how people quietly sabotage themselves. In a taxable account, dividends are taxed, capital gains are taxed, every sale creates friction. Over long periods of time, that tax drag compounds just like returns do. Except it compounds against you. Two investors can earn the same market return and end up with radically different outcomes simply because one used tax-advantaged accounts first and the other didn't. That doesn't make taxable investing bad. It just means it belongs at the end of the sequence, not the beginning. Most people never get here. Not because they're incapable, but because they never build the system that allows progress to stick. They chase motivation instead of structure. They look for shortcuts instead of order. If you've followed this entire path, you're no longer relying on discipline alone. You've built something that works even when you're tired, distracted, or unsure. You've stopped trying to look smart with money and started doing what actually works. And years from now, when the results finally show up, it won't feel dramatic. It'll just feel inevitable. When you zoom out and look at everything we've covered, a pattern becomes impossible to ignore. Financial stress doesn't come from a lack of effort or intelligence. It comes from building in the wrong order. Most people try to grow without first becoming stable. They chase returns while ignoring risk. They focus on excitement instead of structure. And over time, that imbalance quietly compounds against them. What actually changes your trajectory isn't a brilliant investment or a perfectly timed move. It's putting the right pieces in place before you ask money to do heavy lifting. When you protect yourself with an emergency buffer, eliminate high-interest drag, capture guaranteed returns, and let your money grow where taxes interfere the least, progress stops feeling fragile. You're no longer one bad month away from unraveling everything you've built. The deeper lesson here is that real financial strength is quiet. It doesn't announce itself. It doesn't look impressive early on. It shows up as calm when something goes wrong, patience when markets get noisy, and confidence in decisions that don't need validation. That's what gives you leverage over time. Applying this to your life doesn't require perfection. It requires honesty. Ask yourself where your money is leaking, where you're skipping steps, and where you're mistaking activity for progress. Then start correcting the order. One decision at a time. Not to feel rich today, but to stop being quietly stressed tomorrow. Before you go, I'm curious, what do you think matters more right now in your situation? Earning more money? Or using the money you already have in a better order? Please share your thoughts in the comments so everyone can learn from different perspectives. And if this helped you see money differently, subscribe to Quietly Broke to support the channel and help us keep making thoughtful content like this. When you zoom out and look at everything we've covered, a pattern becomes impossible to ignore. Financial stress doesn't come from a lack of effort or intelligence. It comes from building in the wrong order. Most people try to grow without first becoming stable. They chase returns while ignoring risk. They focus on excitement instead of structure. And over time, that imbalance quietly compounds against them. What actually changes your trajectory isn't a brilliant investment or a perfectly timed move. It's putting the right pieces in place before you ask money to do heavy lifting. When you protect yourself with an emergency buffer, eliminate high-interest drag, capture guaranteed returns, and let your money grow where taxes interfere the least, progress stops feeling fragile. You're no longer one bad month away from unraveling everything you've built. The deeper lesson here is that real financial strength is quiet. It doesn't announce itself. It doesn't look impressive early on. It shows up as calm when something goes wrong, patience when markets get noisy, and confidence in decisions that don't need validation. That's what gives you leverage over time. Applying this to your life doesn't require perfection. It requires honesty. Ask yourself where your money is leaking, where you're skipping steps, and where you're mistaking activity for progress. Then start correcting the order. One decision at a time. Not to feel rich today, but to stop being quietly stressed tomorrow. Before you go, I'm curious, what do you think matters more right now in your situation? Earning more money? Or using the money you already have in a better order? Please share your thoughts in the comments so everyone can learn from different perspectives. And if this helped you see money differently, subscribe to Quietly Broke to support the channel and help us keep making thoughtful content like this.